Hi, my name is Rajiv Rebello, and I'm the principal and actuary of Colva Insurance Services. This is the fifth video in our series of how choosing the wrong life insurance policy can be a $21,000 mistake. In this video, we'll cover the often discussed topic of whether you should buy permanent insurance for your long-term needs, or just buy term and invest the difference in premiums elsewhere. You've probably heard this discussion in other places, but unfortunately the people providing you with this advice are either insurance professionals with a limited understanding of finance, or financial professionals with a limited understanding of insurance. Insurance professionals or agents are incentivized to sell you as much insurance as possible, whether you need it or not, in order to maximize their commission. If the insured loses $21,000 on a poor financial decision, the agent is still incentivized to have the policyholder make that decision, as long as he gets to keep his full commission. Financial professionals, on the other hand, don't have the insurance knowledge to understand exactly how to structure insurance products in a way that maximizes value and return. For those thinking about permanent insurance, we'll show you the pitfalls in this video to avoid so that you don't end up losing tens of thousands of dollars on this type of transaction. We'll also show you how savvy individuals, corporations, and banks use permanent insurance to gain great long-term after-tax returns on these products. It's also important to remember that before you consider purchasing this type of long-term insurance and investment product, that you speak with a professional who is an expert in designing and structuring these products. At Colva, we use our experience in having helped to price and design these types of policies in order to make life insurance companies profitable, to ensure that our clients are getting the maximum return possible while minimizing their risks. The second type of insurance is called permanent insurance, and it combines life insurance and investments. The purchase coverage lasts for the lifetime of the insured, and the premiums paid on the policy go towards two components. The first is towards life insurance expenses, just like the term policy, and the second is towards a tax-deferred cash value account that you can think of as similar to a 401k. As long as this cash value account is positive, the policy stays in force. Permanent insurance is often referred to as buyer's insurance because just like a house, you're willing to pay more for it up front because you plan on keeping it for a longer period and also want to benefit from the equity appreciation over time. The three main types of permanent insurance are whole life, universal life, and variable universal life. These three offer various levels of risk and return, with whole life having a very low risk level, but also a very low return. Universal life also offers low risk, but offers a much higher return than whole life. Variable universal life offers the highest potential return, but also the highest risk, because it allows you to invest directly in the stock market. The pros of this type of coverage are that it affords you the ability to have lifetime insurance protection, as well as equity appreciation rates that are greater than what you'd find elsewhere with similar risk. The cons are that just like a house, it has high upfront expenses, as the premiums for these policies in the early years can be 5 to 8 times higher than 30-year term premiums for the same face amount. These types of policies also have high back-end expenses and low liquidity for the first 15 years of investment. In other words, if you try to cancel the policy in the first few years and walk away with your cash value, the life insurance companies will charge you a high cancellation fee, which in most cases will result in you walking away with less money than you actually paid into the investment. It's also important to note that when you die, you only get the death benefit amount of the policy, and not the cash value that has accumulated. So let's just go ahead and summarize the ideal qualities that make people suited for purchasing a permanent life insurance policy. The first are people with long-term insurance needs, such as young couples with small kids. The second are people who are financially committed to keeping the policy for greater than 15 years, and ideally greater than 20 years. This of course, is very important. If you keep the policy less than this, as you'll see in the following slides, you'll end up losing thousands of dollars, and probably tens of thousands of dollars on the transaction, and would have been much better off purchasing a term policy and investing the difference in premiums elsewhere. The third are individuals and corporations who are looking to make a play on tax-deferred investment gain. As we'll see in the following slides, permanent life insurance offers a great way to earn great, long-term after-tax returns that are superior to what you would get in the market with similar risk. For these reasons, many banks and large corporations hold billions of dollars worth of cash value life insurance on their balance sheets. In fact, in 2011, banks such as Bank of America, Chase, Wachovia, etc., had over $123 billion worth of permanent cash value life insurance on their balance sheets. The fourth are wealthy people looking to avoid the estate tax. High net worth individuals have their estates and assets taxed at high rates when they die, prior to their heirs inheriting their wealth. However, the death benefit proceeds from life insurance policies are exempt from these taxes. For these reasons, high net worth individuals often purchase large permanent life insurance policies simply to be able to pass on their wealth to their heirs without having to pay estate taxes. So now let's go ahead and evaluate two strategies for long-term insurance needs. The first is buy a permanent insurance policy, and the next is buy term and invest elsewhere. We're going to evaluate these strategies looking at someone who keeps the policy for 30 years and seeing which strategy is better for them. And then in the next slide, we're going to look at someone who doesn't keep the policy for the full 30 years and seeing which strategy is best for them. In this case, we're going to be looking at, again, a 35-year-old male non-smoker who's interested in purchasing $1 million permanent life insurance policy. Again, remember that a permanent life insurance policy is a cash value account product, which means that as long as you pay more than the minimum premium required to keep that policy in force for 30 years and less than the maximum premium allowed by investment and insurance law, you're allowed to fund that policy however you please. So we're going to be looking at three premium funding patterns for this example. The first premium funding pattern is known as the minimum premium funding pattern, and what that is the minimum premium to keep that policy in force for 30 years. So you can see that this minimum premium schedule is $3,072 for the first 10 years, and then you pay no premiums after that. You're just benefiting from the tax-deferred cash value and accrual, which again compounds interest. So we can see here that averages to about $1,000 a year. The next premium funding pattern we'll be looking at is a target premium funding pattern, and it's called the target premium funding pattern because this is the premium which is the target for agents as their commission is dependent on it. In this case, the agent gets 85% of the first year premium the policyholder pays up to about $5,000, which is the target premium, and nothing above that. So he's kind of incentivized to get you to pay $5,000 at least in the first year for this policy. The next premium funding pattern we'll be looking at is the maximum premium funding pattern, which is about $10,500 a year. Again, this is the maximum you can pay into the policy each year and have it stay within the confines of insurance and investment law. So the next category over here we'll be looking at is what do I get back after 30 years by paying these high amounts of premiums for this permanent life insurance policy? Well, you can see that for the minimum premium pattern, if you pay this $3,072 for the 10 years and then wait 30 years, you'll get $30,000 back, roughly. Again, for the target premium funding pattern and maximum premium funding pattern, you'll see that these amounts are a lot higher, simply because you're, again, putting in a lot more in, and you're also benefiting then from more compound interest and tax-deferred cash value accrual. So now let's look at the buy term and invest strategy elsewhere. So what we're going to be doing is saying, let's say this individual just purchases the 30-year term, $800, and the difference between the permanent premium funding pattern premiums, which we can see here, is invested elsewhere in U.S. Treasuries. Again, we're going to be assuming this individual makes 2.56% on these treasuries after taxes because they're in the 25% tax bracket. So let's go ahead and evaluate this. Again, the 30-year term policy, there is no difference, right, to invest elsewhere, so you return nothing at the end of 30 years. You just have paid roughly $24,000 and don't receive anything back. In this scenario, the minimum premium funding pattern, for the first 10 years, you take the difference between $3,072 and $800, which is about $2,400 for the first 10 years, and you invest that elsewhere. At the end of 30 years, you get $22,520 from employing this type of strategy. We can see that doing that same type of strategy for the target premium, you just take the difference between this $4,992 and this roughly $800 for the 30-year term premium, invest it in treasuries earning 2.56%. You'll have $190,000 after 30 years, and obviously the maximum premium funding pattern, you'd have $443,000 after 30 years. Well, the first thing you should notice is that, this permanent strategy amounts for all three funding patterns is higher than the alternative strategy of buy a term and invest elsewhere. And we can see that here in the after-tax gain from purchasing a permanent insurance policy, which is just this after-tax cash value amount column after 30 years minus the after-tax buy term and invest strategy amount. So even in this minimum premium funding pattern, where you're just looking to keep the policy in force for 30 years, you're better off purchasing the permanent insurance policy because you'll ultimately end up with $7,000 more than just the buy term and invest elsewhere strategy. Obviously, the more you put into this type of product, the higher your returns and higher your gains are from doing the permanent insurance strategy as opposed to the buy term and invest elsewhere strategy. For those financial gurus out there like myself who want to see, well, what's the actual return on investment for this type of policy, you can see that in the last column here, the after-tax return on investment. So even in this minimum premium funding pattern, you're earning 3.34% on your investment in a permanent insurance policy. And obviously your return is higher if you put more money in because, again, compound interest and cash value accrual. And that's why you're able to get these gains you see in this column, the after-tax gain from purchasing a permanent insurance policy, because your return on investment is greater than the 2.56% you'd be making in if you were to pay or invest directly in treasuries and pay taxes on it each year. Well, that obviously should bring up an important question is, well, if I'm investing in these types of treasury bonds by myself and only earning a 2.56% return after taxes, what exactly is the life insurance company investing in which allows them to get such high returns, between 3 and 4% on an after-tax basis? Because obviously whenever you see high returns, that usually means there's higher risk. But in this case, the answer to the question is U.S. Treasuries. Now, this shouldn't make sense to you, right? Because how is the life insurance company able to invest in treasuries and get an after-tax rate of return on investment greater than what you could get investing on your own? And the answer is because of poor policyholder behavior. As we'll see in the next slide, very few people end up actually keeping this type of permanent insurance policy for the full 30 years. In fact, most end up canceling it early and end up getting very poor returns because of the high surrender charges. So what happens is very few people benefit from this life insurance policy and the returns, and most people actually end up getting a poor deal out of it, as we'll see in the next slide. So now let's go ahead and evaluate the permanent insurance strategy versus the buy term and invest elsewhere strategy if the policyholder doesn't end up keeping the policy for the full 30 years. So we can see here we're going to look at the target premium funding pattern simply because that's the premium, that pattern that most policyholders end up paying. We're going to look at the returns on investment after every 5 years throughout the 30th year. So we can see in the first and second columns that at the end of the first year, the policyholder is at age 36. At the end of the fifth year, he's age 40, and so on. The next column shows the gross premiums paid to date at the end of each corresponding year. So we can see at the end of the first year, the policyholder has paid the target premium of almost $5,000 a year. At the end of 5 years, he's paid a total of almost $25,000 into the policy in premiums. At the end of the 10 years, he's paid almost $50,000 in premiums, and so on. In the next column, we look at the after-tax cash surrender value at the end of the year. In other words, what would the policyholder get back if he decides to cancel the policy and walk away at the end of each of these years? So the first thing that should strike you as a little bit shocking is that at the end of 5 years, even though he's put in $25,000 into the policy, if the policyholder decides to walk away, he doesn't get anything back. And there's two prime reasons for why this happens. The first is that in the early years of a permanent life insurance policy, the majority of your premiums are going towards paying off high life insurance expenses. You can kind of think of this similar to your mortgage, where in the early years, the majority of your mortgage payment is going towards paying off the interest on your loan, as opposed to paying down the principal on your loan, which only happens in the later years. Similarly, with a life insurance product, and a permanent life insurance product rather, in the early years, the majority of your premium is just going towards paying off these high life insurance expenses. And it's not until the later years that the majority of your premium is going towards building this tax-deferred cash value accumulation. In fact, if we just look at these columns here, the after-tax cash surrender value at the end of the year and the gross premiums paid to date, we can see it's not really till year 15 that the after-tax cash surrender value you're getting at the end of the year is greater than the $75,000 you put into the policy. So now let's go ahead and look at the after-tax buy term and invest strategy for each of these corresponding years. So this after-tax buy term and invest strategy is just taking the difference between this roughly $5,000 a year target premium pattern and the $795 a year term premium, and taking that difference, which is about $4,200 a year, and investing that directly in 30-year treasuries, which are earning 2.56% after taxes. So if we take that $4,200 on an after-tax basis and invest that into U.S. treasuries, at the end of the first year, you'd have almost $4,300. So after 5 years of employing this strategy, you'd have $22,000 using this after-tax buy term and invest strategy. The next column over, the net gain from purchasing a permanent policy, just looks at the gain for the after-tax surrender value at the end of the year and subtracts the after-tax buy term and invest strategy amounts to determine the net gain from purchasing a permanent policy. So the first thing you should notice is that through 15 years, this amount is negative, which means you're better off buying a term policy, investing the difference elsewhere. We can see that here, that after 15 years, you'd have for $77,509 by using the buy term and invest elsewhere strategy, but only $77,403 by using the buy permanent policy strategy, which is a loss of $100 roughly. So it's not until years 20 and forward that you're actually better off buying a permanent policy as opposed to just buying a term policy and investing the difference elsewhere. But we see if you do invest for the full 30 years, you can gain $50,000 more than what you would have gained if you would have just bought term and invested elsewhere. The next column over again shows our internal rate of return or returns on investment for purchasing a permanent policy as opposed to just buying a term policy and investing elsewhere. We can see that in the early years, right, through year 5, you can't actually calculate a return on an investment or IRR because you're not actually getting anything back from the permanent policy. In fact, through year 10, this return is negative. It's not until year 15 that we see a positive return on investment, and it's not until years 20 and forward that this return on investment is greater than the 2.56% return you could get by investing elsewhere straight in U.S. Treasuries. The next column over shows our death benefit internal rate of return or return on investment. All this is looking at, again, from a financial perspective, if you spend this amount of premiums and die at the end of the year and get the $1 million death benefit, what's your return? So we can see that these returns are very high in the early years, and of course this makes sense because you're spending very little on premiums but getting a very high face amount policy back. But even through 30 years, even if you pay $150,000 worth of premiums on this policy, you're still making 11% IRR or return on investment, which is a lot higher than this 2.56% after-tax return that you'd be getting by investing in treasuries. So we can see here quite clearly that if your intent is to keep this policy for 20 years or more, then you're in fact better off purchasing a permanent insurance policy as opposed to buying term and investing elsewhere. However, in the next slide, we'll look at the actual percentages of people who end up keeping this policy for 30 years and the percentages who end up keeping it for less than 20 years.